Hey everyone, welcome back to Corporate Decoder, where we make sense of the confusing world of corporate finance. And today we're looking at Origin Materials Incorporated's latest filing. Let's just say they are making some big moves, and we are here to figure out exactly what they mean for you. So what is the big deal with Origin Materials Incorporated's new filing? Well, they've just announced a plan to raise a significant amount of money through a deal involving convertible notes. Think of it as borrowing money that can eventually be turned into company stock. They are planning to issue as much as $100 million in these notes, with an original issue discount of 10%. That means for every $100 in debt they create, they are effectively only getting $90 in cash up front. Because of that discount, the money from these notes will be coming in stages or tranches, which is pretty common. This whole process is governed by something called a securities purchase agreement. Now let's break down what these convertible notes really are. They are essentially loans that the company can repay not just with cash, but also by giving holders shares of the company's stock. If certain conditions are met, these notes have no stated interest rate, which might sound great for the company, but it typically means the discount or the conversion price of the stock is set in a way that compensates the investors for not getting regular interest payments. They mature 30 months after the final day of the month in which they are issued, offering a clear time frame for repayment or conversion. The really interesting part is how these notes can become stock. The initial conversion price is set at about 63 cents per S-share. This price can change if the company does things like issue stock dividends or splits its shares. The company is also saying they need to get approval from their shareholders to issue more than 19.99% of their outstanding stock. This is a common move when companies raise funds through stock conversion, because they want to avoid potentially diluting existing shareholders too much. Without this approval, they can only issue a limited amount of stock via these notes. The first part of this deal, the initial closing, is expected to happen around November 17th, 2025. At this first closing, they'll be issuing $16.7 million worth of these notes and will receive $15 million in cash after that original issue discount. Following that, if they get the shareholder approval they need, they can have more closings for up to 80. $3.3 million more in notes potentially, but there are limits on how much they can issue within a 12-month period, capping it at $50 million. Now let's talk about how the company plans to pay back these notes, or more accurately, how they plan to manage their obligations. Starting December 1st, they have to make monthly payments. These payments can be made in cash, but here is a twist: they can also be made by issuing more stock if certain equity conditions are met. This means they are giving investors shares instead of cash for these monthly installments. The amount they pay in stock is tied to how much stock is being traded and is calculated as the greater of $2 million or 20% of the total stock traded that month. When they choose to pay with stock, the conversion price is set at the lower of the current conversion price, or 92% of the average stock price over a 7-day trading period. There is also a floor price, which is about 10 cents below which they won't convert the debt into stock. This structure is designed to be a bit of a hybrid, offering flexibility for the company, but also ensuring investors get a decent deal either way, either through cash or stock at a favorable price. Like any major financial agreement, these notes come with a list of what are called events of default. These are basically triggers that, if they happen, can cause the entire debt to become immediately due and payable. Some of these include if trading of their stock gets suspended, if they fail to make payments, or convert the notes on time, or if they fail to keep enough shares set aside for potential conversions. They also have to maintain at least $20 million in unrestricted cash in accounts controlled by the note holder. Another critical default clause relates to their key executives Matt Plavan, the CFO, and John Bissell, the CEO. If either of them resigns or can no longer perform their duties and a suitable replacement isn't found within 30 days, it could trigger a default. If a default occurs, the company could be on the hook for the full principal plus a 10% penalty, essentially a higher repayment amount. On top of that, default interest will accrue at a rate of 12% annually. This means that if things really go sideways, the cost of borrowing for the company can shoot up very quickly. So this whole deal is being done through a registered direct offering, which means they are selling securities directly to an investor. They're using an existing registration statement, which is a document filed with the Securities and Exchange Commission that allows them to sell stocks or bonds. The company has also entered into a security agreement. This is a crucial part of the deal where Origin Materials Incorporated is essentially pledging substantially all of its personal property assets as collateral for these notes. This gives the lenders a strong claim on company assets if Origin Materials Incorporated cannot meet its obligations. We have to look at the documents themselves. The full text of the notes, the purchase agreement, and the security agreement are filed as exhibits. These are crucial for understanding all the nitty-gritty details. Plus, they've included a legal opinion from their lawyers, Cooley LLP, confirming the legality of issuing these notes and the conversion shares, and also a consent from Cooley LLP allowing them to use that opinion. Now let's focus on a few key numbers from the exhibits. While there isn't a full financial table in this section of the document, we do have the structure of the deal. The key financial takeaway is the plan to raise up to $100 million with a notable original issue discount. This means they are giving up almost 10% right off the bat to get this funding. The conversion price at $0.62616 per S-share is quite low, suggesting the company expects its stock price to potentially rise significantly from this level, or it is a reflection of the current market valuation and risk profile. The monthly amortization payments starting at $3 million in cash or $2 million in stock effectively create a steady drain on company resources that needs to be managed carefully. The 20% of aggregate daily traded volume for stock payments is a big dynamic element. If trading volume is high that month, they could end up issuing a lot more stock than anticipated, potentially diluting shareholders significantly. Looking at the whole picture, Origin Materials Incorporated is in a phase where it needs capital to fund its operations and growth. This convertible note offering is a way to get that capital, but it comes with strings attached, especially the potential for significant stock dilution and the risk of default if certain financial or operational benchmarks aren't met. The fact that they are pledging their assets as collateral underscores the importance of this funding and the lender's concern over risk. Now here's my take on this whole situation. Origin Materials Incorporated is clearly signaling a need for substantial funding. The convertible note structure offers flexibility by allowing them to potentially avoid immediate cash outlays for repayment if they can convert to stock. However, this is a double-edged sword. If the company's stock price doesn't perform well, they'll be stuck with cash repayment obligations. The significant original issue discount and the conversion price suggest the market sees a fair amount of risk here. The dependency on shareholder approval for issuing more than 19.99% of their stock is a critical hurdle. If they don't get it, their ability to raise the full $100 million is significantly curtailed. Furthermore, the monthly amortization payments, especially if paid in stock tied to trading volume, could lead to substantial dilution for existing shareholders if the stock price remains low or trading is highly active. The collateralization of the notes is a stark reminder that this is not just a friendly loan. A lot is riding on Origin Materials Incorporated's ability to execute its business plan and generate sufficient revenue to eventually manage these obligations. The executive clauses are also important to watch. The health and stability of their leadership team are directly linked to their financial stability. In conclusion, Origin Materials Incorporated is undertaking a major financial maneuver to secure funding. It is a strategy that could fuel their growth if successful, but it carries significant risks of dilution and financial distress if performance falters. Investors and existing shareholders should be closely monitoring the shareholder vote on share issuance and the company's operational performance in the coming months. Alright, that is our breakdown of Origin Materials Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description below. Thanks for watching, see you next time.